Today we're going to discuss Chapter 7 that covers stocks, stock valuation, and the stock market equilibrium. We're going to discuss features of common stock and how to value common stock, as well as what preferred stock is and how to value preferred stock. We're going to discuss the efficient market hypothesis and implications of the efficient market hypothesis. But the primary thing that we'll do in this chapter is calculate the value, the intrinsic value, of common stock, what common stock is actually worth. So common stock represents ownership. Ownership implies control. The shareholders elect the board, who hires the CEO, who hires the managers, who hires the employees. Managers act as agents of the shareholders, and their goal is to maximize stock price. Shareholders may appear at the annual meeting to vote in person, but they typically transfer their right to vote to another party by means of a proxy. Board members are elected every year, but typically boards are classified or staggered. That means that only 1/3 of the total board of directors is re-elected each year, so it would take 3 years to completely replace a board of directors, the entire board of directors. Most firms only have one class of stock, where all shares would have equal voting rights. But there may be additional classes of stock that have different voting rights. Classified stock has special provisions. You could classify existing stock as founder shares with voting rights but dividend restrictions. New shares may be called Class A shares with voting restrictions but full dividend rights. So a company may have multiple classes of stock. They may have Class A, Class B, and Class C shares. Each would differ with respect to their voting capabilities. So Class A shares may get 1 vote per share of stock, while Class B shares get 100 votes per share of stock. This is typically put in place because the founding family members want to maintain control of the company, so they would issue themselves stock with greater voting rights so that they could make the full decisions of the company without having to consult others. Tracking stock allows one to separate cash flows to allow separate valuations based on different parts of a company. So the dividends of tracking stock are tied to a particular division rather than the company as a whole. Investors can separately value each of the divisions. And it's really nice because it's easier to compensate division managers with tracking stock, because there are many instances where one particular division of a company is doing really well while another division is doing poorly. So you wouldn't want to reward the division that's doing poorly or punish the division doing well simply because you're only valuing the company as a whole. Tracking stock usually has no voting rights, and the financial disclosures for the division are not as regulated as they are for the entire company. So as I said at the introduction, the main thing that we're going to do in this chapter is value common stock. We have 3 different methods. We have the dividend growth model, where we can assume constant growth or non-constant growth. We have the free cash flow method, and we can use price earnings multiples. So again, the intrinsic stock price is the true value of the company's stock, and it must be estimated. If the market is efficient, the gap between the market price and the intrinsic value should be minimal, and if there is a difference, it shouldn't persist very long. The goal is to invest in stocks that are undervalued and to sell stocks that are overvalued. So before we get into any calculations, we first need to understand the terms. So P0 with a hat is a stock's intrinsic value. P0 without a hat is the actual market price of the stock today. D0 is the most recent dividend that has already been paid. And DT is the dividend that the shareholder will expect at time T. RS is the required rate of return, and R hat S is the expected rate of return. So a stock's value is equal to the present value of dividends. You may say, well, that's not true. The actual value of the stock would be the present value of the dividends that I'm going to receive plus the capital gains that I'm going to receive in the future. But the capital gains that you're going to receive in the future depends upon the future dividends at that point. So the amount that the next investor is willing to pay is dependent upon the amount of dividends that they expect to receive. So the stock's value is equal to the present value of all future dividends. A stock with constant growth is one whose dividends are expected to grow at the same rate forever. And the growth rate here is G. The constant growth model is suitable for mature companies with a stable history of growth. And there may be some stocks with zero growth, so they expect to pay a constant dividend forever. In those instances, the growth rate would be 0. So if the growth rate is constant and it's less than the required return, then the intrinsic value of the stock is equal to the next dividend payable divided by the required return minus the growth rate. The thing to remember here is that you have to use the next dividend payable, D1. D0 is the last dividend that was paid. If you're given D0, for example, if I give you a problem that says Company X just paid a dividend of $2, $2 would be D0. It has already been paid, so it doesn't factor into our calculations. So if you need to calculate the next dividend payable from that information, you would use this formula up here. So the next dividend payable would be equal to the last dividend paid, the $2, times 1 plus the growth rate. And here's an example. Company X just paid a dividend of $1.15. They've already paid this dividend, just paid, so this is D0. Its stock has the required rate of return of 13.4%. Investors expect the dividend to grow at a constant 8%. So what is the stock's intrinsic value? We first need to calculate the next dividend payable. The next dividend payable would be D1, and that's equal to the last dividend paid, $1.15, times 1 plus the 8% growth rate. So pull out my calculator. Okay, there it is. It's 1.15 times 1.08 to give us 1.242 is the next payable dividend. So the intrinsic value of the stock is equal to the next dividend payable, the 1.242, divided by the required return, 13.4%, minus the 8% growth rate. And that gives you $23. So the intrinsic value of this stock is $23. The sum of the present value of future dividends is the stock's intrinsic value. It assumes an infinite number of time periods, but most of the value is based on dividends during a finite time period. 70% of a firm's value is attributable to the next 25 years. 91% of firm's value is attributable to its next 50 years in business, while 99.4% is attributable to the next 100 years. So we don't have to assume that a company is going to be around forever. Increasing next year's dividend will have little impact on the stock price because the stock price includes all future dividends. Value is due to long-term cash flows. 80% of a company's stock price is attributable to cash flows expected further than 5 years into the future. So short-term fluctuations are not going to have a huge impact on a stock's value. So why do we care about quarterly earnings reports at all? That's because it can tell you about the future. If earnings are less than If earnings are less than what was forecasted because of high research and development, this may signal greater growth in the future. If, however, earnings are less than those forecasted because there weren't enough sales, it may signal poor performance in the future because customers don't like the product. So quarterly earnings are not really that important, but the information they confer about the future is important. So in the last example, I just simply gave you the required return. But we used the security market line in the previous chapter to determine required returns. So we can do that right now. Remember, required return is equal to the risk-free rate plus beta times the market risk premium, which is the market return minus the risk-free rate. So it's the risk-free rate plus beta times the market risk premium. So we can calculate the required return. The required return in this example is 7% plus a beta of 1.2 times the market risk premium of 5%. Fix this plus sign here. And that gives you a required return of 13%. So if we have a stock and we know that they just paid a dividend of $2 and they have a required return of 13% and their growth rate is 6%, we can calculate that firm's intrinsic value. Remember, we can do this because the stock's intrinsic value is equal to the last dividend payable times 1 plus the growth rate divided by the required return minus the growth rate. So with the information we know, the last dividend payable was $2 times 1 plus the growth rate of 6%, divided by the required return of 13%, minus the growth rate of 6%. That gives you an intrinsic value of $30.29. One may argue that assuming a constant growth rate is silly, but if a company is mature, a constant growth rate is a fine assumption, especially because most of the value from a firm is not from recent years. So it's attributable to greater than 5 years into the future. So we can smooth out dividends. There may be some dips here or there, but overall, dividends tend to increase at a reasonably constant rate if you're smoothing them over time. So we can calculate the expected value 1 year from now. We just calculated the expected value right now, so the intrinsic value of the stock today was $30.29. We can calculate the expected the intrinsic value in 1 year, so the intrinsic value at time plus 1. And that would be equal to the dividend payable 1 period after that, divided by the required return minus the growth rate. So that would be the last dividend paid multiplied by 1 plus the growth rate squared. So we have $2 times 1 plus our growth rate, and we square that, divided by the required return of 13% minus a growth rate of 6. And this is going to give you $32.10. So you can continue this to see what you expect the stock's intrinsic value to do. So we can calculate the dividend yield and the capital gains yield. But first, it may be more important to come up with a generic formula for intrinsic value. So the intrinsic value of a stock at time period T, where if it's today, time would be 0, is equal to the dividend at time plus 1 divided by the required return minus the growth rate. So you can calculate intrinsic value for any time imaginable. But we can calculate dividend yield and capital gains yield. To calculate dividend yield, it's equal to the next dividend payable divided by the current price. And again, if markets are efficient, the current market price and the intrinsic value should not differ. So D1 would be equal to our $2 dividend times 1 plus 6%, so $2.12, divided by the current price, $30.29. So that gives us a dividend yield of 7%. We can also calculate a capital gains yield. And that would be equal to the expected price at time period 1 minus the price today divided by the price today. So it's just changes in stock value. So 3210 minus $30.29 divided by $30.29, and that gives you 6%. So if you add the dividends yield and the capital gains yield together, that gives you total return. The dividend yield plus capital gains yield is equal to total return. So here for our example, the dividend yield was 7%, and we had a capital gains yield of 6%. So that gives us total return equal to 13%, which is equal to our required return. For constant growth stock, the capital gains yield is always equal to the growth rate. So in our example, the capital gains yield should equal 6%, which it did. If you wanted to turn the equation around to where it equaled rate of return, it would simply be the next dividend payable divided by today's price plus the growth rate. So for our example, we should get 13%, but we can make sure. So our next dividend payable was $2 times 1 plus the 6% growth rate to give you $2.12. We divide that by the current price, the intrinsic value, they should be the same, $30.29, plus a growth rate of 6%, and that's equal to 13%. I did mention that the growth rate can be 0. We can expect dividends to not change in the foreseeable future. If the growth rate is equal to 0, the dividend stream would be a perpetuity. And remember, we calculated the present value of a perpetuity as the cash flow divided by the required return. So the present value of a perpetuity is cash flow divided by required return. And so we can use this equation to calculate the intrinsic value of our stock. If the growth rate is 0, the intrinsic value is equal to the payment or the cash flow divided by R, which makes sense. You don't have to memorize this equation, because remember, our equation for the intrinsic value of a stock is equal to D1 over R minus G. If G is 0, then it would be simply D1 over R. And D1 is equal to D0 and D2 and D3. So you just pick a dividend. So it would be $2 divided by 13%, exactly the same as the formula for the present value of a perpetuity. So there's no need to memorize any additional equations. So we can calculate this. $2 divided by 13% gives you $15.38. So the intrinsic value of a stock with 0% growth rate, dividends are expected to be $2 forever, and the required return is 13%. The intrinsic value of this stock is $15.38. So for a constant growth stock, the following conditions must hold. These generally do hold for large mature companies. 1. The dividend is expected to grow forever at a constant rate. The stock price will also grow at this rate. The expected dividend yield is constant. The expected capital gains yield is constant and equal to the growth rate. And the expected total rate of return is equal to the expected dividend yield plus the expected growth rate. But what if we don't think that the growth rates will be constant? Then we can no longer use the constant growth model. For many companies, constant growth is not acceptable. Firms do go through life cycles. During early years, growth is much faster than that of the economy, and then it slows. So it's normal to see companies with a very high growth rate in its early years to slow down in the future. So then you would expect growth rates to change. Growth rates may also decline. So a company is declining over time. It can have a negative growth rate. So let's work an example. Let's assume that we have a company that just paid a dividend of $2. They expect supernormal growth of 30% from year 0 to 1, 25% growth from year 1 to 2, 15% growth from year 2 to 3, and then we expect long-run constant growth of 6%. The required return is 13%. So again, it helps if we put this on a timeline, just like we have every other problem in this course. So again, D0 has already been paid, so that does not factor into our valuation of the company. From time period 0 to time period 1, we anticipate a growth rate of 30%. From time period 1 to time period 2, we have a growth rate of 25%. And from time period 2 to time period 3, we anticipate our growth rate to be 15%. And from after time period 3, we anticipate the growth rate to be a constant 6%. So we anticipate dividends to continue into the future. But for calculation purposes, we need to calculate the next dividend payable, so the next dividend at time period 4. After time period 3, remember, the growth rate becomes a constant 6%. So we can calculate dividend values at each of these different time periods. So our dividend at time period 1 is equal to our $2 dividend, D0, times 1 plus the growth rate of 30%, to give us $2.60. From time period 1 to 2, we anticipate the growth rate to be 25%. So we take our last dividend payable, the $2.60, and multiply it by 1 plus the growth rate of 25%, to give us a dividend payable of $3.25. To calculate our dividend at time period 3, we take the $3.25 and multiply it by 1 plus our growth rate of 15%, to give us a value of $3.74. And we need to go ahead and calculate it one period further. We always calculate it to one period past where the growth rate becomes constant. So the growth rate became constant at year 3, so we need to calculate dividend values at year 4. So we take the $3.74 and we multiply that by 1 plus our 6% growth rate, to give us $3.96. So because the growth rate is not constant in years up until year 3, we can't use the constant growth rate model. We take the present value of each of these cash flows individually, or we use our cash flow worksheet on our financial calculators. So the first step is to calculate the intrinsic value of the stock at time period 3. We do this because at time period 3, we can use the constant growth rate model. So the anticipated value of the stock at time period 3 would be equal to the dividend at time period 4 divided by R minus G, the required return minus the growth rate. So here for our example, it's $3.96 divided by 13% minus 6% to give you $56.60. So now that we've gotten the intrinsic value of the stock at time period 3, we can ignore all cash flows that occur after time period 3. So we can just mark an X through the rest of the time because those cash flows don't matter anymore because they've already been represented in our intrinsic value at time period 3, the $56.60. So we can put this into our cash flow worksheet on our calculator. You push the cash flow button. I'll work it on my calculator in just a moment. So you push the cash flow button and it asks you for the cash flow at time period 0. At time period 0 we have nothing. Remember that the D0 was $2, but that's already been paid. So cash flow at time period 0 is 0. Cash flow at time period 1 is equal to D1, the $2.60. You just look at time period 1 and you see that there's only one cash flow associated with that time period. It then asks you the frequency of the first cash flow, 1. You can always skip frequencies. Cash flow at time period 2 is dividend 2. There's only one cash flow at time period 2, the $3.25. The frequency of the second cash flow is 1. And cash flow at time period 3 is where a change happens. At time period 3, we're receiving a dividend, and we know the intrinsic value of the stock at time period 3, so we need to add those together. Dividend at time period 3 plus the value of the stock at time period 3. So $3.74 plus $56.60. So we can put this into our calculator. First, $3.74 plus $56.60 would give us $60.34. So now we can put these into our cash flow. So you push the cash flow button located to the right of the second button. Remember, if you want to clear your cash flow worksheet, you have to first open the cash flow worksheet. So you push this button, and then you can push second and clear work, and now your cash flow worksheet should be empty. So cash flow at time period 0 is 0, so we push 0, enter, and the down arrow. It now asks us for the cash flow at time period 1, which is dividend 1, 2.6. Don't forget to push the enter button. That's what stores it. Push the down arrow. It asks for the frequency. We can skip that, so push the down arrow again. Cash flow at time period 2 is dividend 2, $3.25. Enter to store it, and then you can push the down arrow twice. And cash flow 3 is the dividend 3 plus the intrinsic value of the stock at time period 3. So $3.74 plus $56.60 to give you $60.34. And you have to push enter to store it. So now, the next step is to calculate the present value of these series of cash flows. To do so, you push the NPV button. Enter in your discount rate, which is our required return, the 13%. So 13 and enter. And a down arrow and compute. So $46.66 is the intrinsic value of this stock. So once you've entered in the cash flows, you need to push the NPV button. The interest rate is 13%, the required return. Push the down arrow and compute. And we found that the intrinsic value of the stock at time period 0, so today, is $46.66. So we can use this and we can calculate the dividend yield and the capital gains yield. The dividend yield is equal to the next dividend payable divided by the price today. We've already calculated D1 on our timeline, and D1 was $2.60. So 2.6 divided by the price of $46.66 gives you 5.6%. We know that total return is equal to capital gains yield plus dividend yield, so we can turn the equation around and we can say required return, total return, which is our required return, return minus dividend yield is equal to our capital gains yield. So we know that our required return here is 13% minus our dividend yield of 5.6% to give us a capital gains yield of 7.4%. If we have non-constant growth, the dividend yield and the capital gains yield are not constant. If current growth is greater than G, then current capital gains is going to be greater than G, our constant growth rate. So after time period 3 in our example, the growth rate is a constant 6%, so the capital gains yield is 6%. Because the required return is 13%, then after time period 3, the dividend yield would be 7%. We get that by taking total return minus capital gains to give us our dividend yield of 7%. Up until time period 3, though, the dividend yield and the capital gains yield will vary, and the capital gains yield will not be equal to the growth rate. So for non-constant growth, the steps that we took: first, we estimated expected dividends for each year during the period of non-constant growth. We defined the expected price of the stock at the end of the non-constant growth period, because at that point it does become a constant growth stock. Then we take the present value of the expected dividends during the non-constant growth period and the present value of the expected stock price at the end of the non-constant growth period. Add those together, and that is the intrinsic value of the stock. So again, remember, stock price is not attributable to short-term actions. If the current stock price is $46.66 and the present value of dividends after year 3 is $39.22, we got this on our timeline. This $39.22 is the present value of our intrinsic value of our stock at time period 3. So it's the present value of the $56.60 that we calculated. So the percentage of the stock price due to long-term dividends, those after time period 3, the 39.22, is 84.1%. So most of our stock price is due to long-term actions. So let's do another example. Here, let's say we have a 0% growth rate for years 1 through 3. After that point, the growth rate becomes a constant 6%. And our last dividend payable, again, is $2. And our required return is 13%. So from time period 0 to time period 1, the growth rate is 0. So the dividend is going to be $2. You could say $2 times 1 plus the 0% growth rate, and that gives you $2. From time period 2 to time period 3, time period 1 is $2. Time period 2, so from time period 1 to time period 2, the growth rate is 0%. So the dividend is $2. From time period 2 to time period 3, the growth rate is 0%. So again, the dividend is $2. After time period 3, the growth rate becomes a constant 6%. So we need to calculate the dividend for time period 4. The dividend for time period 4 is the dividend for time period 3 times 1 plus the growth rate of 6% to give you $2.12. We don't have to calculate dividends any further than that because after time period 3, we can use the constant growth rate formula. So we can determine the value of the stock at time period 3. It would be equal to the dividend at time period 4 divided by R minus G. So $2.12 divided by 13% minus 6. And that gives you $30.29. So now that we've gotten the value of the stock at time period 3, we can ignore anything after time period 3. And we can put these into our cash flow worksheet. So we push the cash flow button. Cash flow at time period 0 is 0. Cash flow at time period 1 is $2. Cash flow at time period 2 is $2. This is dividend 1 and dividend 2. These are the only cash flows that occur at these times. And then our cash flow at time period 3 is going to be equal to the dividend at time period 3 plus the price at time period 3. So D3 plus price at time period 3. So $2 plus the $30.29. We then push the NPV button, enter in the interest rate of 13%, down arrow, enter, and compute. So we want to push the cash flow button. We need to clear that out. We push second and clear work. Cash flow at time period 0 is 0, so enter in the down arrow. Cash flow at time period 1 is $2. Enter, down arrow twice. Cash flow at time period 2 is $2. Enter, down arrow twice. And cash flow at time period 3 is $32.29. Enter. We now push the NPV button. Enter in our discount rate, our required return of 13%. Enter. Down arrow. And compute. To give us $25.71. So this stock today is worth $25.71. So we can calculate our dividend yield. Dividend yield is equal to the next dividend payable, $2, divided by the current price, $25.71. To give us 7.8%. So now we can calculate our capital gains yield. Equal to our total return minus our dividend yield to give us 5.2%. After time period 3, we have constant growth rate. So our capital gains yield is going to be equal to our constant growth rate of 6%. Now we can calculate our dividend yield. Would be equal to our total return, our 13%, minus our capital gains yield of 6%, to give us a dividend yield of 7%. What if we have a negative growth rate? If the growth rate were a negative 6%, would anyone buy the stock? If this is a declining stock, firms are still earning money and they are still paying dividends, but this dividend is declining. So the price today would be greater than 0. So we can work this problem. Remember that the intrinsic value of the stock, P0, is equal to D1 divided by R minus G. So here we can calculate D1. D1 is equal to D0 times 1 plus the growth rate. Again, we'll continue with the same example. We'll say that they had a dividend of $2 and a required return of 13%. So an example continuation. Our dividend was $2 times 1 plus a negative 6%. So 2 times 0.94. And that would give you 1.88. So $1.88 divided by our required return minus our negative growth rate. So that would be 1.88 divided by 0.19 to give you $9.89. So yes, this stock still has value and people would still purchase it. Because the growth rate is constant, we do have a negative capital gains yield, so it's a negative 6%. But the dividend yield is now 19%. Both yields are constant over time, with the high dividend yield offsetting the negative capital gains yield. We can also use price earnings multiples to estimate stock price. Analysts often use price earnings multiples, the price per share divided by earnings per share. For example, you would estimate the average price earnings ratio of comparable firms. This would be the price earnings multiple. So the average price earnings ratio for an industry would be a price earnings multiple. Again, if you're using this methodology in your paper, you need to be sure and define your industry correctly. You then multiply this average price earnings ratio by the expected earnings of the company. to estimate stock price. So you could use an earnings forecast, multiply that by the average price earnings ratio of a set of comparable firms, and that would give you an estimate of stock price. So here's an example. Company X has earnings per share of $7.70. The average price earnings ratio for similar companies is 12. So the intrinsic value would be equal to our $7.70 times 12 to give you $92.40. Again, the most important thing with this is to correctly identify the industry. Alternatively, you could use entity multiples. So an entity value you could use is the market value of equity plus the value of debt. You pick a measure such as earnings before interest and taxes, depreciation and amortization, sales, the number of customers, etc. And you calculate the average entity ratio for a sample of comparable firms. So for example, you would take the entity value, the market value of equity, plus the value of debt, and divide it by the average number of customers, or the average sales. So you need to find the entity value of the firm in question. You multiply the firm's sales by the entity value divided by the sales multiple, so the average sales of the industry, or by the customer ratio, and this would give you the firm's total value. You subtract the firm's debt to get the value of equity, and then divide by the number of shares to calculate the price per share. Difficulty with market multiple methods is that it's often hard to find comparable firms, and the average ratio of comparable firms may vary drastically. So for example, the average price earnings ratio might be 20, but the range could be from 10 to 50. So how do you know if you should compare to the low, average, or high performers? So next we're going to discuss preferred stock. Preferred stock is a hybrid security. It's similar to bonds in that preferred stockholders receive a fixed dividend which must be paid before dividends can be paid on common stock. But unlike bonds, preferred stock dividends can be emitted without the fear of bankruptcy. So if a company can't afford to pay preferred stock dividends, they can simply postpone them. There's no obligation for them to be paid. To get the value of preferred stock, it's simply equal to the dividend of preferred stock divided by the required return of the preferred stock. So we can calculate expected return. We know that the value of a preferred stock is $50 and its annual dividend is $5. So we can calculate its required return. We're simply changing the equation around. So we have 2 of the 3. So we know value of preferred stock is equal to the dividend of preferred stock divided by the required return of the preferred stock. So the required return would be equal to the dividend of $5 divided by the value of $50 to give you a 10% required return on the preferred stock. So why are stock prices so volatile? First, the required return could change. So the risk-free rate could change, or the market risk premium could change. This could be changes in risk aversion, in company risk, or changes in inflation. And secondly, our growth rates can change. Our anticipation of future events can change. So here we look at what happens when the required return and the growth rate changes. How does that affect stock price? So you see here in the top line that if the required return remains constant, but the growth rate increases 2%, we're going to have a $26 change in stock price. If growth rates become constant, but required returns increase, our stock price is going to vary by approximately $12. So we see lots of changes. If the growth rate and the required return change, they offset one another. So the availability of information causes stock prices to be volatile. Stable stock price means that little information is arriving to the market. Small changes in expected growth rates and required returns cause large changes in stock prices. As new information arrives, investors update their estimates of growth rates and required returns. So these estimates are continually being updated and are continually changing. If the stock price is not changing, if it's not volatile, then there isn't a good flow of information. In equilibrium, the intrinsic value is equal to the actual stock price. If the actual stock price is less than the intrinsic value, the fundamental value, then the stock is a bargain. Investors will buy orders will exceed the sell orders, and the price will be bid up. If the actual price is greater than the intrinsic value, sell orders will exceed buy orders. So the price will fall. In equilibrium, expected returns must equal required returns. So here we have our dividend yield plus our growth rate is equal to our required return, which would be equal to the required return you get with the security market line. If the dividend yield plus the growth rate, the total return, is greater than the required return, the price is too low. If the price is less than the intrinsic value, the stock is a bargain. People are going to buy the stock and bid the price up until the dividend yield plus the growth rate is equal to the required return. So that brings us to the efficient markets hypothesis. The efficient markets hypothesis says that securities are normally in equilibrium. So the intrinsic value is equal to the market price of the stock. One cannot beat the market except through good luck or through inside information. The efficient markets hypothesis does not assume that investors are rational, but it does assume that the stock market prices are very similar to intrinsic values. If stock prices deviate from intrinsic values, investors will take advantage of this mispricing. Prices will be driven to a new equilibrium level based on the new information. And it is possible to have irrational investors in a rational market. There are three forms of the efficient markets hypothesis. First is weak form efficient markets hypothesis. This simply says, if weak form efficient markets hypothesis were true, information about recent trends in stock prices would be of no use in selecting stock. The fact that a stock's price has risen over the past 3 days would give us no indication of what would happen today. If there were a reliable pattern, other investors would catch on and it would soon disappear. So you can't profit by looking at past trends. Evidence supports weak form efficient markets hypothesis but some still use technical analysis. Semi-strong form efficient markets says that all publicly available information is reflected in stock prices. So it's of no use to read the paper or watch the news or look at annual reports to find undervalued stock. And this is largely true. Strong form efficient markets hypothesis says that all information, even insider information, is already embedded in stock prices. If one person knows it, then it's already incorporated in stock prices. This is not true. It does not hold. We know that because insider trading is illegal. Insiders can gain by trading on the basis of insider information. Most studies suggest the stock market is highly efficient in the weak form and reasonably efficient in the semi-strong form. We assume that markets are generally efficient because there are 100,000 or so trained analysts who have lots of money and lots of data, and so they're able to access information quickly, and so news is reflected in the current market price almost instantaneously. The problem with proving whether or not the market is efficient is that research uses joint testing. They test whether a particular strategy can beat the market. So if there is a strategy that can beat the market, it has not yet been tested. But strong form efficient markets hypothesis does not hold. For most stocks, most of the time, it is safe to assume that the market is efficient. However, periodic major shifts can and do occur, causing some stocks to move strongly up or down. The implications for market efficiency. Many investors have given up trying to beat the market, which explains why index funds are popular. We just buy a mixture of stocks to gain the effects of diversification without having to pay a pension fund manager or mutual fund manager mega bucks to do this for us. If the market prices stocks fairly, managerial actions based on over and undervaluation do not make sense. Managers do have better information, but they can't use this for their own advantage and cannot deliberately defraud investors. Stock market bubbles in 2000 and 2008 suggest that something other than pure rationality in investing is alive and well. People anchor too closely on recent events when predicting future events. When the market is performing better than average, they tend to think that it will continue to perform better than average. Other investors will follow them, exaggerating these circumstances. So in conclusion, markets are rational to a large extent, but they also are subject to irrational behavior. One must do careful, rational analysis using the tools and techniques that we're covering in this course. It is important to recognize that actual prices can and do differ from intrinsic values, and these do happen sometimes by large amounts and for long periods. In general, however, intrinsic values are very close to actual values. But these differences between actual prices and intrinsic values provide wonderful opportunities for those able to capitalize on them.